James Knightley is Chief International Economist at ING. He's joining us now to take some questions. James, good to have you with us here. Thank you very much for your time. So just a quick word, James, on markets and what they've done last night and what it means. Dollars sharply down. I mean, actually, just two things stand out. Sharp rebound in equities, dollars, which is now sharply lower, and oil, which has bounced back a little bit to 75, although I'm not sure anyone is paying attention there. What does it mean for what does this backdrop mean for EM equities, especially India, James?
Yeah, I think the Feds did they did a good job. I think it was a hawkish 50 basis point cut, if you can describe it as that. Basically giving a clear message that the Fed is very much in the soft landing camp. They think the underlying fundamentals are solid. It's just that the inflation backdrop is improving, and that allows them to provide a bit more insurance for the economy by moving policy rates back to more neutral levels, out of restrictive levels, just to ensure that that nice ongoing growth story can continue. I think the Fed are trying to angle for a mid-1990s cycle where they've had policy in restrictive territory. They can take the foot off the brake a little bit just to give the economy a little bit more breathing space to continue, driving along quite nicely. And that positive US backdrop in an environment where even Europe's looking okay. We had the Bank of England yesterday, not changing policy. We've had Brazil actually raising rates once more. So there's still some underlying confidence that the underpinnings of the global growth story is still looking pretty good. And for now, until something changes in that developed market story, in that US story, I think it should continue to provide a solid base really for risk sentiment in general, and of course emerging market equities and in Indian equities too.
All right. So I guess, no discomfort from the U.S. Federal Reserve. But James, hi, morning. I also want to get your views on the Bank of Japan. And that, for me, at least, is the more interesting one, right? Because if you look at data, even this morning, those inflation numbers continue to inch higher. Growth numbers have been inching higher, almost at 3% as per the last print. So how long do you think they can remain on hold? And if they do start raising, say, in October or December, then what does that do to the whole carry situation?
Yeah, no, morning. It was an interesting one because, of course, remember what happened back in July. We had that interest rate rise, which caught the market a little bit off guard, that 15 basis point rate hike that came through. And, of course, what happened was the next day, the Fed pivoted to become much more relaxed about inflation, focusing more on jobs. And then 2 days after that, we had that very soft US jobs number. And we saw US interest rate expectations plunge as the yen soared. And there was concerns at the time about some financial market instability potentially stemming or coming from this big dollar-yen move that could potentially have hurt some investors, some hedge funds, and there was a little bit of anxiety about what that may mean. So I think that caution, it continues to play a little bit in the Bank of Japan's mind. They've seen some really big moves in dollar-yen from the low, sort of 160s to the low 140s. And that, of course, does help at the margin tighten monetary conditions. It does act as a bit of a brake on inflation as well. So that's a good news story. So we're of the camp that we'll probably get the Bank of Japan holding today. And we are looking for them to hike, but perhaps it may not come until December this time around.
Right. The obvious question then is with the money, which is now a little more cheaper than what it was before the 50 basis points rate cut, where does it find its way? In what asset classes, what geographies? What are your expectations? Where does the incremental money go to?
Well, the US is still awash with liquidity. We've still got banks putting money back in the Fed deposit at the Federal Reserve. We've still got trillions of dollars sloshing around in money market funds as well. So, there is the potential for these funds to move, if, as we expect interest rates to continue falling, that money may well seek a new home. But of course, it also depends on the macro backdrop as well. And at the moment, everyone's sort of really buying into this narrative that the US is in a soft landing, the US can move policy back to neutral and everything's going to be fine. Well, the jobs market is a clear worry. The Fed did cut 50 basis points. They think, that they do perhaps need to move to neutral quite quickly to ensure that they do get that soft landing. It's not guaranteed. And I think, we are going to be closely following these jobs numbers. So for now, There's very few firings going on, as we saw with the jobless claims numbers. But the hiring story has really weakened dramatically. And the quality of the jobs that the US is adding has deteriorated as well. There's much more part-time, it's much more low-paid jobs. So there is a general sense that the economy is cooling. And for now, the assumption is it's going to cool and stabilize. But you never know. It could carry on just a little bit further.
Okay, all right, James, we'll leave it on that note for this morning. Thank you so much for joining in. Have a good Friday and a good weekend, and we look forward to connecting again soon.